What's going on, y'all? Welcome to another edition of Weeds Weekly and happy Monday. Weeds Weekly once again is... What's going on, y'all? Happy Monday and welcome to another edition of Weeds Weekly, where I, Kevin Weedmark, just walk you through what happened this past week in the mortgage space, what data came out, and what has it got traders thinking. We're going to also talk about this week and what we can anticipate with all the data coming out. How might that impact the interest rate market, and looking forward, what it could mean for the month of October, because we are here, right? Tomorrow is October 1st. It's a great reminder that how fast time flies and how time just does not stop. It's the most valuable commodity, bar none. And then we're going to talk about, what else do I have on the docket? Don't do it. We're going to talk about common mistakes that I feel a lot of borrowers are making. I feel we're in kind of this educational standpoint right now where we have this election coming. We know that things are going to be a little bit slow. We're having a lot more conversations, especially if you're out there, you're working it, you're active. And what a great time to be having good educational conversations with people. So I want to talk about some common mistakes. And then we're also going to talk about give me a reason. One of the biggest questions I get to right now, number one, is where do I think interest rates are going to be for the rest of this year and into 2025? And then the other big one I get is, should I refinance? So I want to touch on those really quick. But let's just dive into last week. And look, it's amazing, right? Last week had a lot of us in the real estate industry scratching our heads. I mean, just when you think it's a great thing that the Fed did the 0.5 point rate reduction, it's almost like a thanks, but no thanks. Because basically what happened this past week and why we saw interest rates go up, that's another huge question that I had all of last week. We got a rate reduction. Why did rates actually increase on mortgages? Again, the market's forward thinking. They already priced it in. And then once the market digested the fact that the Fed did a 0.5 point rate cut, fears of inflation started kicking back in. You have to remember, right? Last year at the end of 2023, the Fed was painting the picture that they had done the right thing. Inflation was coming down. All the rate reads were happening. So what happened? A lot of traders bought into that, only to be burned. In January, only to be burned. In February, only to be burned. March, April, and so on and so forth. So it was a continuing trend. So you're going to see a lot of traders right now, once the dust settled, they were like, whoa, 0.5 point? That might put more money into the economy. We might now have, once again, more dollars chasing goods. You're going to lower payments for a lot of people. You might have really overstepped your bounds. So you had a lot of traders just being anxious over the fact that they think inflation could potentially be a problem because, again, right, you have this lag effect. What the Fed did is not going to make itself over into the mortgage rates, long-term mortgage rates, probably till a little bit down the road, and it's not going to funnel its way in through the economy for months down the road. We saw that lag effect on the upside. So you just have a lot of traders that were anxious, and that really was the big news of last week. However, by Friday, some of those fears were put to bed. And I wouldn't say fully, but what you had is what came out on Friday? And I'm losing my brain here. PCE, personal consumption expenditure, came out. It's an inflationary measure, and that actually was lower than forecast. So what it just kind of spelled is, look, everything the Fed has done is worked. So therefore, inflation is coming down, so maybe a decrease is good, but I think traders were still a little bit skeptical. But what it did is it created a new ceiling. I believe the 10-year Treasury now has a new ceiling of about 3.8%, unless something drastically changes this week, and we're going to talk about that really quickly. However, the other big thing that happened last week is consumer confidence fell off the map. It was the largest drop we have seen since April. And if you recall, right, again, I go back to what I just talked about. The Fed was making this big to-do about inflation's under control, blah, 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 blah. Towards the end of last year, everyone was feeling great. The holidays, high five, Santa came, he gave me everything I wanted, only to be put in a bad situation that they were wrong. Inflation was now stubborn. Inflation was going up. Inflation was sticky, blah, 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 right? We heard all that rhetoric. And what we saw is consumer confidence in April have its largest decline. Well, we saw that again this past month. And what the Fed is really going to hope is that that's just a bump in the road, because simply that would mean that a slowing economy, which could obviously affect GDP, which could obviously push us into a recession if it gets that bad. I don't think those fears are really there yet. However, it is something that we definitely want to keep an eye on. So what do we have coming this week? Well, we have taking center stage once again is going to be the labor market. And we have jobs data starting tomorrow with the JOLTS report. And it is something every single day till we get to Friday when we have the non-farm payroll number and we have the unemployment number. And my expectations are, I think the labor market is stabilizing a little bit. I think you're going to see some numbers that beat forecasts. I think you're going to see a couple that are under. I don't really see any big surprises this week. However, is it a week that could absolutely move the market? 100%. And it really is going to fall on those numbers, and the big numbers it's going to be on Friday, that non-farm payrolls number. And if you see jobs just explode, you're going to see it affect the market. And if you see that jobs fall off the radar, that's going to be a problem as well, because what it's going to mean is that potentially that dot plot that the Fed laid out, well, now all of a sudden that's going to change, right? Where they were talking about another 0.5 point for this year. We will not get that probably if the labor market is really hot. We probably will not get that. And if it falls off the map, then you're going to have traders that are going to be very concerned of, oh, we could be slipping into a recession. So, and when you have people that are fearful of slipping into a recession, they usually go to something a little bit more safe, which is the treasuries, which could potentially push rates down. So that's kind of the landscape of what we can look at coming up. And then we also get a peek into manufacturing. Manufacturing is really heavy on the data side this week, where you get surveys of purchasing managers and whether they think that we're in a growing market or we are in a somewhat of a receding market from the manufacturing standpoint. But a lot of it is all just around labor, right? Because if manufacturing is picking up, that's going to mean more job hiring. So the labor market is on full display this week. Make no mistake about it. All right, so a couple topics where we always, or at least I, try to give us some ammunition of how we can have just good educational conversations with our clients, whether getting them off the fence, making another point of contact for a touch of, hey, I want to give you a little heads up. So I try to dive into that a little bit to give you guys something to speak to them about. So what I'm going to talk about on this one is going to be don't do it. What are some common mistakes that people make when looking for a mortgage? And the first thing, and I talked about it all the time, is they don't worry about their credit scores. They don't go find out what their credit scores are. They don't look at improving those credit scores. I've talked about credit optimization. I think 75% of the clients should be doing it. And if they're not, they're making a grave error, because your credit score, your client's credit score, directly affects the yield spread, therefore the interest rate they get. So that's number one. Number two, they're not shopping around, right? They take your word for it. You're comfortable with a lender, whatever the case may be. They're not shopping around enough. Look, they need to learn how to shop. I've covered that before, and I can cover it again another day, or we can have a quick conversation. But they're not shopping around. They're not doing themselves a favor by doing that, right? They want to shop around. They want to ask certain questions. They want to go with the person they feel most comfortable with, that can close on time and is giving them the best rate and costs. So that's number two. Number three is not knowing all the costs. I can't tell you how often I get a phone call from a potential buyer and they are uncertain that they even had to come up with anything other than the down payment. They just don't really understand how it works, or they forget how it works, or they just simply haven't put pen to paper. So they're like, oh, what am I going to need? Like 10 grand? And they're off by 10 grand. It's actually 20 grand. So again, it's always great to get that mortgage professional. My point is, early in the process, you want to make sure that your clients are engaging. If they're 90 days out, they should be talking to somebody like me now, right now, so that I can best position, help them get their credit scores, help them understand all the costs. And then the fourth thing is not getting a pre-approval. I see it a lot. I see a lot of people that will come to me. They don't have a pre-approval. They already have a house under contract. The beauty of the pre-approval, right? It educates the client so that when you're out there showing them homes and they need to make a quick decision, maybe on a competitive situation, or they need to do some quick math in their head, by talking to somebody like me, they're gonna know what an extra $1,000 is to them per month, what an extra $5,000 could mean. how to think about their overall flow of cash, monthly payments, so that while you're out there and working with them and saying, hey, I see this house over here, it's 20K more, let me go show you what 20K could get you, they can do the math and say, yeah, we're comfortable with that. That's an extra 100, 150 bucks a month, and we're down with that. We'll go look at that. So it's really important that they get that pre-approval. And then the last thing I wanted to talk about is, what was I gonna say? Give me a reason. And the last topic was, look, the biggest questions I get two of them. What are interest rates gonna do? The remainder of this year and next year, I got all that covered. And then when should I take a look at refinancing? I got a few things. Number one, if you wanna pay your closing costs again, which right now I don't think in this environment you do, you wanna at least be saving 1% in your interest rate. So if you're at 7 now, you wanna get to 6. And the reason that you wanna do that is that cost savings per month, you're gonna have to pay a capital outlay between 2 and 5%, right? That's typically what they say closing costs are. Your break even on that, you never want that break even to be more than 2 years. Meaning that if it costs me $4,800 in closing costs and I'm saving $200 a month, that's gonna be 2 years for you to break even between what you're gonna have to pay, capital outlay. Even if you increase your loan amount, you're still increasing your principal balance, right? You wanna have that 2 years or less, because the reality is interest rates can always change, situations change, you need to move for whatever reason, job relocation, family issues change. You then wanna at least have another 2 years to get that savings. So now you actually save $4,800. So I always like to say you at least have to save 1% if you're going to do a refinance where you are going to pay all your closing costs. On the flip side of that, if the lender, i.e. me, can save the client and pay their closing costs, and the reduction is a quarter point, 3/8, a half, all that's gravy. It's immediate savings. It's right away. So I always encourage people to take a look at that. The other reason that you might want to change the terms. So I get a lot of clients that, look, they have lifestyle changes. They got a promotion. Whatever the case may be, they get a windfall. Somebody passed away, they get some money. So they want to basically restructure their loan, and maybe they want to go from a 30 to a 15, or maybe they're having kids. So the wife is no longer going to work. They want to move from a 15 to a 30. So again, these are just topics that you can be having with your clients, writing them. Hey, if you have a lifestyle thing, these are things to think about. I'm concerned about touches for you, touches for your client, so you stay top of mind, right? Doesn't always need to be about real estate, but these are topics you can cover. Your client took an ARM. So right now, look, ARMs way back in the day were really, really prevalent. They weren't obviously through all the really low interest rates, but they've taken off recently, probably within the last 6 months to a year, because interest rates were so high, especially last year. You want to make sure, if you know your client got an ARM at the time, that you're calling them. Hey, by the way, don't forget that you have that ARM. Right now might be a great opportunity to look at getting out of that ARM, restructuring it. Even if you move at the same interest rate from an ARM to a 30-year fix and pay no costs, you're securing that rate for a 30-year term. There's benefits to that. And the last thing is you need to eliminate mortgage insurance. The funny thing about an FHA loan, as great as they are, and I think there's really a place for them, particularly for first-time home buyers, you can never eliminate mortgage insurance. You have to get out of that FHA loan. So it's not an option. So any client that you have that you know at one point you got into an FHA loan, you may want to call them and remind them that if they have that 20% equity position, coming soon might be a great opportunity, or even now might be a great opportunity to refinance that home, get into a new 30-year term, and remove that mortgage insurance. All right, y'all, I hope that is helpful. I hope that gives you reason to pick up the phone, talk to your clients, maybe put a marketing piece together. If you need some help with that, I'm happy to do something for you, with you. You can put your name all over it. I don't care. But if you have any questions this week while you're out there, please do not hesitate to call, email, text, whatever it is that you may need. I am here to help you. Of course, I'm working all week. I hope you have a great one, and I will talk to you soon. Take care. Cheers.